Hello and welcome to my new channel, Accounting with Sandra. My name is Sandra and I'm an accountant and lecturer, and I'm hoping to help students and those with a keen interest in accounting and taxation to understand accounting and taxation concepts with videos in 5 minutes and under. In this video, I'm hoping to explain and clarify the concept of equity. Over the next couple of videos, we will discuss the remaining types of account balances, which are revenue and expenses. Assets and liabilities have been discussed in my previous videos before bringing them together to discuss the four main types of financial statements. So let's begin. What is equity? Once again, while there is no specific accounting standard which defines what is equity, we can refer to the Statement of Accounting Concepts number 4. SAC 4 defines equity as the residual interest in the assets of the entity after the deduction of its liabilities. So let's dissect this definition. Given that equity is the residual or the leftover balance after deducting an entity's liabilities from their assets, let's do a quick recap of what assets and liabilities are. Assets are the future economic benefits controlled by the entity as a result of past transactions or other past events. In other words, they are the items which are held by the entity which they anticipate will result in a future benefit. For example, an entity holds property, plant and equipment which they can use in their day-to-day operations which provide future economic benefits. Machinery can be used to manufacture their inventory, a warehouse can be used to store their inventory, and trucks or vans can be used to deliver the inventory. Liabilities, on the other hand, are the future sacrifices of economic benefits that the entity is presently obliged to make to other entities as a result of past transactions or other past events. The entity acquires the parts required to manufacture their inventory. They have to pay for these items, which are a future sacrifice of economic benefits. As such, equity is the remainder or the balancing amount after liabilities are subtracted from the total assets. Together, assets, liabilities, and equity form the balance sheet or the statement of financial position. So let's visualize how this looks with an overly simplified balance sheet. This balance sheet assumes that we are in our first year of operations, and as such there are no comparatives or prior year figures to be disclosed. On our balance sheet we have assets. In this case we only have current assets, which is made up of our cash balance. Remember that current assets are those assets that we intend to benefit from within the next 12 months. So our total assets here is the $100,000. If we held other assets, they would also then be included within the total assets line. Our liabilities in this case are accounts payable. That is all the invoices that have been issued to us and are due for payment within the next 12 months. As they are due within the next 12 months, accounts payable are showing as a current liability. The difference between our assets and our liabilities is shown in the line item net assets. Given our definition of equity being the residual of assets less liabilities, then our equity balance must also be $90,000. When we come down to the equity section, we have two account balances. Share capital, which is made up of the cash received upon the issue of shares in our company, and retained earnings, which is the account into which we transfer the net profit or loss made from our business operations each year. In this case, the sum of our first year operations and our share capital is $90,000, which agrees back to our net assets line. Where our net assets and our total equity balances do not agree, it means that our balance sheet does not balance. There is something wrong somewhere that needs to be seen to. And some of the more common types of equity accounts for you to be aware of include share capital, which once again recognizes the value of the company's shares on issue. Reserve accounts. Now, reserve accounts are discussed in various accounting standards, and as we get to those, we will discuss them in a little bit more detail. We can have capital contributions and drawings, which are two accounts which look at any personal contributions or withdrawals by owners of a business, and retained earnings, which once again accumulates your net income or loss generated by the entity at the end of each financial year. I hope this video has helped to clarify the concept of equity. My next video will consider what are revenue accounts. Thank you.